Welcome to Delphos Insights. Today we're doing a deep dive into something truly transformative, how artificial intelligence is driving financial inclusion across emerging markets. We've been looking at sources that show how these systems are completely rewriting the rules of access.
It's so important because we're talking about an immense gap. Despite decades of work, as of 2025, you still have roughly 1.4 billion adults without basic financial services.
1.5 billion people.
Exactly. And AI is really the critical technology here. It lets these economies bypass that old, slow, expensive legacy infrastructure and deliver services directly.
You know, that really brings to mind a quote from Bart Turtleboom that I think frames this perfectly. He said, "Artificial intelligence is not just changing how finance works, it is redefining who finance works for."
Right.
Intelligent systems are closing the gap between ambition and access faster than any traditional reform ever could.
And that speed is possible because AI goes straight for the biggest barrier, which has always been traditional credit assessment.
So if you didn't have a formal credit history, you were basically invisible to a bank.
Completely invisible.
That's fascinating. So AI isn't just a better calculator, it's a tool for radically changing risk perception. So if that paper trail doesn't exist, what kind of alternative data are these models actually looking at?
Well, they look at a person's entire digital footprint. We're talking massive amounts of data processed in real time. Things like digital transactions, utility payments, sales cash flows for, say, a small business, even mobile phone usage patterns.
Mobile phone usage.
Yes, and supply chain transactions too. By analyzing all these different inputs, financial institutions can build a really accurate, inclusive risk profile for someone who, before this, had no formal identity.
And we're seeing this play out in a huge way in India's lending sector, right?
Exactly. Fintechs there are leveraging AI to analyze transaction data from the Unified Payments Interface, the UPI system. It handles something like 85% of all digital transactions in the country.
So they use that data to provide tailored working capital loans to micro and small enterprises.
They do. And the key insight really is that AI turns routine digital activity into immediate creditworthiness. That it directly tackles an estimated $5.2 trillion global financing gap.
So that's lending in India. But AI is also about accessibility and trust. What's the story, for instance, in Kenya?
In Kenya, you have to look at M-Pesa. It's a classic example. They use these predictive fraud detection algorithms to spot anomalies in real time, which is just essential for keeping user trust. And on top of that, they're using natural language processing for chatbots, which really improves access for people who might have lower literacy or can't get to a bank branch.
And then in Latin America, it seems the focus is a bit more on efficiency and compliance.
Absolutely. Banks are using AI for KYC, that's Know Your Customer, and AML, anti-money laundering processes. It dramatically speeds up onboarding new clients while making regulatory compliance stronger and, of course, cutting huge operational costs.
Okay, so all these successes bring up a big question. If we're automating so much of finance, what happens to the people who work in finance?
It's a shift towards synergy. Automation is handling the repetitive, data-heavy tasks, which then, augments human expertise. It doesn't really replace it. That synergy is what defines intelligent finance.
So traditional roles are evolving. A loan officer becomes more of a data translator.
Right, interpreting the AI insights for the client.
And compliance teams become AI risk stewards. The consensus seems to be that this is going to require reskilling about 40% of the financial workforce. We're already seeing big investments in AI literacy programs in places like India's financial sector.
But when we implement these powerful systems, we also have to be very careful. There's a real risk of amplifying existing inequalities through data bias.
How so?
Well, if a model is trained on a data set that isn't representative, maybe it underrepresents rural populations or women, it can bake that bias right into the system. So transparency, accountability, fairness, these have to be the core principles.
And governance is finally starting to catch up. We're seeing different approaches, like the EU AI Act with its strict risk-based rules. Then you have India's RBI, which seems more focused on enabling innovation first with its free EAI framework. But the research suggests only about a quarter of organizations have fully implemented AI governance programs, which just highlights how urgent this is.
And this whole transformation is being built on a foundation of enormous investment. The data points to a US $750 billion investment wave in AI-grade infrastructure data centers, 5G, all of it across emerging markets.
That foundation is fueling some massive growth. By 2030, the global market for AI and financial services is set to exceed $190 billion. It's growing at over 30% a year, all driven by digital public infrastructure, these new AI solutions, and better regulatory alignment.
It really just proves that technology, when you apply it thoughtfully, can genuinely start to dismantle these systemic barriers for billions of people.
So, considering the necessity of strong AI governance, how can financial institutions effectively balance rapid AI innovation with the continuous monitoring required to prevent inherent data bias from becoming permanently embedded in global financial systems? This has been Delphos Insights. Learn more at delphos.co.